In the late 1970s, the price of silver was just $4.50 an ounce. By early 1980, it had exploded by nearly 10 times to over $47 an ounce. To put that in perspective with today's prices, if you overlay the 1970s rally on today's market, a similar move could send silver up to $800 an ounce. Most people think that rally was driven by inflation and speculation, but there was also a massive supply crunch back then. Today, there are potential signs the same setup could be forming again. With silver prices nearing a retest of historical highs, the big question is, could we see a repeat of the 1970s silver boom? That's what we'll dig into in this video. The 1970s were a wild time for financial markets. Oil shocks caused an inflation tsunami that reached a height of nearly 15%. To fight this, the Federal Reserve hiked interest rates up into the double digits to nearly 20% at one point. As interest rates soared, so did long-term bond yields, indicating a collapsing bond market, pushing investors to search for alternative safe haven assets. They turned to gold first, and its price soared by 600%. But as gains began to slow, investors rotated into silver, seeking more upside. As this new wave of investment capital poured in, demand for silver surged, and this quickly began to overwhelm supply, leading to a demand shock. That's due in large part to how silver is mined. Unlike gold, silver is primarily mined as a secondary byproduct of other metals, like copper, zinc, and lead. That means silver supply is inelastic. It's slow to respond to changes in demand. Silver suddenly shifted from an industrial use metal to a store of value, and huge inflows of capital led to a shortage, sending prices sky high. Now, with that history in mind, are we seeing some of those dynamics in today's market? There are some parallels. Gold has been on the rise, roughly doubling over the past 3 years and reaching all-time highs, but silver is well below all-time highs. We're also seeing major turbulence in the bond market, much like in the 1970s. That pushes investors into alternative stores of value, like gold and silver. As gold has well surpassed all-time highs, that's when investors begin to rotate into other precious metals to chase even more returns. And that's why we could very well see silver prices attempt to catch up like they did in the 1970s. So, if rotation is potentially underway, what could drive silver's demand even higher? First, industrial demand, which is the biggest piece of the pie, is poised to keep growing. Silver is a critical component in solar panels, electric vehicles, and other electronics, all burgeoning industries. To give you some context on this growth, in just 10 years from 2014 to 2024, demand for silver and solar panels grew from 5% of the total global silver market to nearly 20%. That's a 4 times increase in its market share. On top of that, there's the investment case, which hinges on a key question. What if we see a repeat of the 1970s dynamic, where investment demand for silver surges as a safe haven asset? Currently, investment demand is about 16% of the silver market. In a scenario where investors rotate capital from a saturated gold market into silver, that share could potentially rise significantly. If investment demand were to double to over 30%, mirroring the kind of investor frenzy seen in the past, it would place enormous pressure on an already tight market. The silver market has been in a structural deficit since 2021, meaning demand has outstripped supply. This fundamental imbalance contributes to rising prices, and because silver is primarily a byproduct metal, mining operations can't just flip a switch to produce more when prices rise. That inelastic supply is a key part of the thesis. Today, global mine supply is essentially flat. On top of that, regulatory hurdles like ESG restrictions, permitting delays, and geopolitical risks add to the challenge. These factors make lead times for new silver mines even longer. So today's supply setup is arguably even more constrained than it was in the 1970s, a period that saw a 10 times spike in silver prices. That said, nothing is without risks. Because silver prices rely so heavily on industrial demand, it makes them vulnerable to an economic downturn. A global economic slowdown or recession could hit this side of demand hard, even if investment demand rises. That would dent the rise in silver. Take 2008, for example. We saw a silver price collapse from $20 an ounce to just $9 an ounce. One of the primary causes was the major decline in industrial demand during the Great Recession, along with panic selling by investors in order to liquidate assets. So there was also a significant decline in investment demand at the same time. There are a few other important risks to silver prices to bear in mind. One is that silver is highly exposed to just a few key industries, like photovoltaics for solar panels, electric vehicles, and in consumer electronics, such as circuit boards. A downturn in any of these industries would likely lead to falling silver prices. And then there are the geopolitical risks to silver prices. Silver is sensitive to tariffs and trade policy risk due to their potential effects on industries that use silver. For example, tariffs on clean energy tech that uses silver, namely solar panels and electric vehicles, could lead to a big decline in industrial silver demand. At Capital.com, we'll keep you updated on the price of silver and other precious metals, along with major market trends. Hit like and subscribe to stay tuned. Thanks for watching.